Hey traders, this is Blake Morrow with Traders Summit, and with me today I have Jim Welsh of Macro Tides. Jim, how are you? It's been a hell of a week. Good to have you here.
It's great to be with you as always on Friday, Blake. I think you probably, like me and most other people who are involved in financial markets, this might have been a 4-day week, but it certainly feels like a 5, maybe even a 5.5-day week, given everything.
It does. It feels like we've actually just worked over the weekend and into the next week as well. So now, before we get into your ideas of what you wanted to talk about this week, let's talk a little bit about Russia. Let's not ignore what happened. How do you feel about what happened with Russia and Ukraine and how it might affect the markets moving forward?
I think it's going to recede gradually, go from the front burner, which it has been for obvious reasons. I think it's a fait accompli that Russia will take over Ukraine. And Putin's attitude is, what are you going to do about it? And the reality is, I think the West is limited because Germany is so vulnerable to energy availability from Russia that I think that will hamper, really putting the hammer down. I may be proven wrong, but I think the reality is, Blake, we will see a gradual return to normal. It's in Russia's smart interest to make sure wheat continues to flow, oil is available. And I think that the issue of Ukraine will gradually go from the front burner to the back burner. And then what's going to come back to the front burner is Federal Reserve monetary policy leading up to the March 16th meeting. I do not believe the Fed is going to be dissuaded, at least in March and May, from raising rates. And I think they're going to communicate that clearly over the next 2 weeks.
I was just going to say, even some comments from some Fed members yesterday saying that unless something happens, I forget the wording that they use, but if something happens beyond our control,
it's going to take something very dramatic that impacts the economy, not so much the financial markets. And I think people keep talking about the Fed put. In this environment, 40-year highs on CPI inflation, I'm not going to say there is no Fed put, but it's going to be tied to what's happening to financial conditions within the financial system and more importantly, the economy.
Well, let's and that makes a lot of sense. And I know a lot of, I think stock market bulls probably don't want to hear that.
Right.
The Fed's not going to be deterred, but let's talk about how you're feeling about the markets right now, because obviously the equity markets created a new low for 2022 just this week. But what happened? We rallied back, and here we are at the end of the week, bouncing back quite nicely. So what do you make of all this, Jim? And I'm going to go ahead and show your image that you brought us.
Sure. Okay. First of all, that rally that began on Thursday morning after a big spike down, I believe was initially instigated by stock buybacks. The mega cap firms have gigantic stock buyback programs. The investment banks that execute those buyback programs do have discretion. I mean, it's to their advantage to buy a big gap down because they get more bang for the buck in terms of the firms they're working for. So as investors yesterday saw the Qs, the NASDAQ 100, which, the mega caps are about 45% of that index, almost 25% of the S&P. So as those buybacks really started to lift the Qs, S&P, I think it gave other people confidence, like, okay, I should be buying this dip. And I think that's what we've seen. I think the rally will probably extend into maybe mid next week or so. But I think that's what started it. I don't believe it tells us a whole bunch about really where we are in terms of monetary policy and everything else. Okay, the chart we're looking at is Investors Intelligence. It's a weekly survey of investment letter writers. How many bulls, how many bears? So the bottom panel is bulls minus bears. In other words, net bulls and bears. And as you can see, back in 2018, they got to about minus 10. And then, of course, in 2020, it got closer to minus 10. Pardon me. I think it was plus 5. I don't have my glasses on. So the black horizontal line says, okay, this is when you're starting to get too many bears. The green says, yeah, this is a lot of bears. And you can see, as of this week's number, we're almost down to that black horizontal line. The point I would make is we all are bombarded by people on TV and what we read. The markets discount the future. I think that's a bunch of crap. Okay, I'll just put it out there, because at every top and bottom, the market is always wrong. I mean, when the S&P hit an all-time high in October 2007, it wasn't forecasting clear sailing. When it was at 666 in March 2009, people were thinking, oh my God, the world's coming to an end. Instead, we got the biggest bull market we've seen in a long time and the longest business expansion in history. So to me, contrary opinion, and I really embrace contrary opinion as much as I can, is a better informative tool than the idea the market discounts the future. So we can see that sentiment has gotten to a point where it's getting pretty extreme here.
Yeah.
So look for at least a decent trading low, I think is, what we all should be doing. Now it comes down to, all right, let's look at things like momentum and price patterns to suggest, all right, have we completed a decline at the lows that we saw on February 24th when the S&P got down to 41.15. And, I don't believe we have. I think there's a good chance that we'll see a rebound and then another low. The main reason at the low in 2018, what happened? The Fed reversed policy going into December 18. They were raising rates. They did a complete shift at that point, and that's really what reversed the market. 2020, as we all know, the Fed threw everything it could, plus we had an enormous amount of fiscal stimulus. We're not going to see that happen. I believe the Fed will raise rates in March and May and continue to talk tough until, and it will take a few months before this would really materialize, that the economy is really buckling under higher energy prices and so forth. Best estimate is, it might shave 1 to 3/10 of GDP over the next 3 to 6 months if oil's at over $100. So we're not talking about a huge impact. And again, I think that's what the market is going to have to contend with. Ukraine kind of dissipates, goes to the back burner, and then I think the Fed becomes a focal point leading up to the March 16 meeting.
Okay, well, let's talk about your specific technicals that you're looking at, Jim, regarding the S&P. But before you do, what I did is I dusted off the image that you brought to us last week. And I don't normally do this, but I wanted, just for those of you that are listening in right now, to actually see what Jim was talking about last week. Last week, you were targeting 4,000 to 4,100 for the end of wave 5 there. But what do you? I mean, did we reach it? Is that enough for you now?
No, but of course the market is going to be the final arbiter of all that. The reason why I think there's another low coming, besides the fundamental aspect, is if you look at this chart, the rally the decline from 48.18 is clearly 3 waves. That makes it an A wave. The rally from 42.23 to 45.95 is an up, down, up, which is a 3-wave move, makes it a B wave. So now the C wave decline should take a form of 5 waves. And I think yesterday's low on the 24th either was wave 3 of 3, or it was just wave 3 of C, and that we should expect a rally, which obviously we got. I sent out a special update yesterday morning saying, okay, the S&P can get up to 43.50 to 43.90, and we're there as of this morning. But I do believe we're going to see, and this rally could extend a little bit more into next week. As we saw, the S&P topped in the first few days of January, hit the secondary high in the first few days of February. For whatever reason, it's like, okay, maybe we'll see a rebound that carries into the first few days of March, but that the top should be in by the end of next week. Then I think we roll over. One important thing, the February CPI, Blake, comes out on March 10th. So just a handful of days before the meeting on March 16th, it's going to go up from 7.5%. So that will renew calls and concerns that, oh my God, the Fed is going to raise the Fed funds rate by 50 basis points instead of just 25. Because 2 weeks ago, it was like 90% were people that, one of the Fed futures were signaling 90% increase of 50 basis points at the March meeting. Then yesterday, it was down to 13%. So now the market's set up to, oh my goodness, maybe the Fed will do a 50 basis point hike. And the trigger for that could be the March CPI, which I believe is going to go up. Now, after that, what I'm writing about in the March macro tides is I continue to believe we're going to see the CPI from the high in March probably drop by 100 basis points when we get to June. And I think that might roll back, from 7 increases in the Fed funds rate for 22, which, remember, in December, we were at 3. And that surprised people because the Fed's dot plot said 3 increases. Then within 2 months, we went from 3 to 7. So I think everybody's rushed to, oh my God, the Fed's going to hike forever. I think there's as I've been saying all along, no 50 basis point hike in March. I think we'll see consecutive quarter point increases. But if the inflation rate starts to come down by 100 basis points in the second quarter, I just think the markets and some of the investment firms say, maybe the Fed won't do 7, maybe they'll do 6. And that's why I believe the pattern that we're looking at is a big ABC from the 4818, that opens the door that not only will the S&P have a pretty good rally in the second quarter, it opens the door that we could go to new all-time highs, which is the path I think is more likely. We're not in a recession. So that is,
and that's something that you discussed last week as well.
Yep.
All right. Well, Jim, I'll tell you what, you've been spot on, and we'll see how this manifests over the next week, because obviously it's still a very fluid situation. I think a lot of people are feeling good going into the weekend. Maybe you got a lot of people that are getting squeezed out of their shorts from getting caught at the lows, but whatever the reason is, the market is a little bit higher. We can only hope that things continue to improve, but we'll see. It's a very fluid situation, right?
It is, and you're 100% right. I'm glad you mentioned it in terms of short covering, Blake, because going into the lead up to the Afghanistan or the Ukraine invasion, the market was truly really hedged in position for, oh my God, the world's about to go to hell. And as I said, stock buybacks, I think, initiated it. And then, as you just pointed out, short covering really has amped it between the low yesterday and what we're seeing this morning. That burns itself out pretty quickly. And that's, again, the Fed isn't coming to the rescue as it did in December of 2018, in March of 2020. And that's why I think the odds favor another dip to a lower low below 41.15 by the end of March, potentially.
All right. Well, Jim, I appreciate your time here with us here at the Traders Summit community. Really quick, if you are new to trading or new to listening to Jim, how do you find out more about what Jim Welsh does over at Macro Tides?
Macrotides.com. And if you send me an email, Jim Welsh, WELSH, macro@gmail.com, I'll send you last Monday's weekly technical review and the special update that I sent out yesterday. That'll give you a better taste of what I'm doing.
Awesome. Well, Jim, thanks for joining us today. And I love our meetings on Fridays. I'll talk to you next week.
Enjoy and relax a little bit over the weekend, Blake.
You do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.